Hi, today I will tell you about news from Wall Street. The major US stock indices ended last week on a low, with the Nasdaq Composite falling for the sixth consecutive session on Friday, marking its longest losing streak in over a year. This decline was exacerbated by a significant drop in Nvidia, amidst broader market challenges including geopolitical tensions and persistent inflation. The tech-focused Nasdaq retreated 2.05% to close at 15,282.01, while the broader S&P 500 also experienced a downturn, sliding 0.88% to end at 4,967.23. This decline brought both indices to their sixth consecutive day of losses, a negative streak not observed since October 2022. Conversely, the Dow Jones Industrial Average saw an increase, rising 211.02 points, or 0.56% to close at 37,986.40. This rise was primarily fueled by a surge of over 6% in American Express, following its earnings report. On a weekly basis, the S&P 500 saw its worst weekly performance since March 2023, driven by increasing concerns over inflation and monetary policy directions. With the loss exceeding 3%, this marked the large cap benchmark's third consecutive negative week. Much of this downward pressure was due to poor performance in the technology sector, which was the worst performing sector in the S&P 500 during the week. The index is currently over 5% below its 52-week high. This week, much of the market's attention will likely be focused on major economic events, including the release of the durable goods report on Wednesday, following by the advanced GDP report for the first quarter on Thursday, and the core PCE inflation report on Friday. We estimate personal income increased 0.50% and personal spending increased 0.65% in March, Goldman Sachs economists said in a recent note. We estimate that the core PCE price index rose to 0.30%, corresponding to a year-over-year rate of 2.76%. Additionally, we expect that the headline PCE price index increased by 0.31% from the prior month, they added. During this period, Federal Reserve officials will not be commenting on monetary policy due to the blackout period preceding the Federal Open Market Committee meeting scheduled for April 30 up to May 1st. In addition to key economic developments, investors and analysts will also be closely scrutinizing the upcoming earnings reports releases this week. On Monday, Citi strategists said they have revised their multivariable regression analysis that combines key macroeconomic indicators with S&P 500 earnings growth. Their updated analysis indicates a very high likelihood of a positive Q1 EPS surprise, but relatively limited guidance follow-through, they said. Better than expected macro data and rising projections imply there is a 50% chance of the S&P 500 reaching or exceeding our $245 full-year earnings estimate. For context, that probability was circa 30% in November, analysts wrote. Several earnings reports will be in the spotlight in the upcoming days, most notably those by megacap giants including Tesla, Meta Platforms, Alphabet, and Microsoft. JP Morgan thinks that the multiple expansions seen in past months, extremely low volatility metrics up to recently tightest credit spread since 2007 and a general inability by market participants earlier in the year to identify any potential negative catalysts for stocks are starting to shift. Market concentration has been very high and positioning extent, which are typically red flags at risk of reversal. Broadly, the combination of macro factors outlined above any move higher in USD yields or in Brent, together with continued elevated geopolitical uncertainty, increases the downside risks and suggests that more defensive trading should be appropriate. Morgan Stanley opined that the recent reversal in data has put the Fed back in hawkish mode and that presents a headwind for valuations. As noted previously, if yields stay at current levels over the next 3 months, multiples could face 5% downside within that period, all else equal, which would equate to 4,700 up to 4,800 on the S&P 500. Thank you for watching, subscribe, leave your comments and thumb ups.